Coming up today, Netflix jumps on a profit beat, chip stocks rally after Taiwan Semi earnings, retail sales come in better than expected, what BOA said about gold, and the next nuclear stock I plan to invest in. It's going to be an interesting one, guys. Let's go. Hey, what's up, guys? Welcome back to the Daily Market Review. We just heard results from Netflix coming in with a profit beat. Earnings per share $5.40 versus $5.11, and just going down to a 5-minute chart after hours as I speak. Stock currently up a little over 4%. We did fall first thing in the morning there. Quickly found support around 10 a.m. Bumping around, finished lower, like the market was expecting a bad result. However, it seems to be pleased right off the bat here. And just looking at some of the news flow we're getting in, they beat on subscriber expectations for the third quarter. It's amazing. For as mature as they are, they can still add 5.1 million new paid subscribers in the third quarter, beat on both the top and bottom line of analysts' expectations. So they expect to pick up more paying subscribers in the fourth quarter. They boost their forecast for operating margins, and actually more than half of their new signups were for the ad tier, as that's proving popular in some other countries around the world. However, analysts were looking for a bit more of a price hike that they didn't appear to get. But overall, they see 43 to 44 billion in 2025 revenue. And so just looking at their market cap, 295 billion. Even if they come in at the bottom end of their revenue forecast range, that puts them at about a forward price to sales of 6.8, which is not cheap, but also not ridiculous for possibly one of the best digital and scalable platforms in the world. Really good business characteristics about Netflix, huge operating leverage, and the market appears to like what it's heard from them. And the fact that they're still really growing, and since they're so dominant in the streaming market, they can pretty much just dial up their prices every year ahead of inflation, and that should just keep squeezing profits higher going forward. We just also heard from Taiwan Semi today, also coming in with a really good result, beating analyst expectations, $1.95 in earnings. After their CEO just said AI chip demand is booming. No surprise there, right? Been hearing that from Jensen Huang. He can't sell enough, and they're a key supplier to Nvidia and pretty much dominate the manufacturing for high-end chips, making it possibly one of the world's most important company that affects the entire supply chain for American technology. No surprise that helped the entire sector rally up today after they said they expect their AI product revenue triple this year. And this is in stark contrast to what we heard from ASML on Tuesday. Said they expected lower sales due to chip export controls to China. However, even ASML managed to hold ground there today. So we're doing some heavy volume here. Still a really important company in the semi industry. But nonetheless, on the back of Taiwan Semi's good result, caused Nvidia to break out to a brand new all-time high today. Just by a few ticks though. Back on the 20th of June, we got up to 140.76. Today we just got up to 140.89. And so we are definitely a little overbought here technically in the short term. Top of my buy-sell band in this resistance box. Got my reversal signals firing off. However, the DSI is still not overbought and the price action is still ranging. And we do have a lot of bullish seasonality still coming into this stock. So don't be surprised to see a big fat green candle above 145. Who knows, tomorrow or next week. And if Nvidia does break out and close above 145, that's likely to get the whole semi sector trading up to a new multi-month high and kind of take out these heavy candles we've been seeing for a few months now. We're ramping up into Q3 earnings season. Another good result today from one of the world's largest asset managers, Blackstone, also coming in with a good beat. 11% on analyst expectations. Ripping up over 6% to brand new all-time highs. Also helping BlackRock find brand new all-time highs again today as well. The asset managers, the actual custodians of a lot of stock out there are performing really well. On deck tomorrow, we've got Procter & Gamble set to report earnings, along with American Express, one of Warren Buffett's longtime favorite holdings. It too, ripping up to brand new all-time highs ahead of earnings. Not doing so well today, Lucid Group, electric vehicle manufacturer coming out of California, saying they're going to sell more shares and sees wider losses. Helped to bring down a few other EV makers today. Popping up, we've got Expedia Group on rumors that Uber may be interested in taking them over, although that's still yet to be confirmed. And as a new Uber shareholder myself, I certainly wouldn't vote for this acquisition as I believe it moves away from their core business. And with the market cap of $20.5 billion, they'd probably have to pay at least 25 or more to get it. But anyway, we'll follow that story, see what happens there. Also breaking out to a brand new all-time high today, gold, continuing its relentless march higher. It's been in for the last couple of months, even though we've got the US dollar doing the same thing now. Simply cannot knock gold over. And even Bitcoin standing up with the strength in the dollar. And I'll come back to this one a little later on, along with uranium. And I'll share with you the next nuclear stock I plan to invest in. I'll tell you all about it. I'll explain to you their technology, and I'll tell you why I'm excited about their future prospects. And there's a look at today's earnings calendar. Once again, a sea of green. Beats all across the place. Financials really performing well here. And just after what we heard from Netflix and Taiwan Semi, appears we are getting a good bounce back in tech stock after they've been largely consolidating quite a few months now. After ripping up in Q1, big tech appears to be coming back. And not just Nvidia either. Still the market's biggest stock, Apple, pretty much sitting at all-time highs, although Microsoft's still been lagging of late. There's a look at Amazon and also doing one of the best, Meta. And if you've ever kicked yourself for selling a good stock too early, don't worry, it happens to the best of us. Even some of the top fund managers in the world that have been doing it all their life. Billionaire Stanley Druckenmiller, in his late 70s, said he regrets selling his entire Nvidia stake and is looking to buy it again. He said he thought the valuation was overextended, but if he got a chance to buy the dip, he most certainly would. Going on to say, I think Nvidia is a wonderful company, and were the price to come down, we get involved again, but right now, I'm licking my wounds from a bad sale there. And that's a sign of a good investor, when they're mature enough to admit their mistake. But just looking at this data today from FundStrat, S&P 500 revenue growth, percentage change year over year, minus core CPI, percentage change year over year delta. So in other words, revenue in real terms, adjusted for inflation, has been accelerating ever since it bottomed out in the second quarter last year. So that's a good sign to see that we've actually got some real growth happening. And just looking at this chart here of the S&P 500's average 60-day rolling forward return in all election years since 1950. So in the blue is the best times to put money to work, in the red, the worst times to put money to work. So just looking at the average 60-day forward return from each point in the year. We're currently right here. We're about to approach the most seasonally bullish 60-day period of the year. And we've got stocks sitting at all-time high, grinding higher in what's supposed to be the most weakest month of the year on so many measures and statistics looking back at history. However, like I say, history doesn't always repeat. There can be key differences, but we still do have an elevated VIX, with it sitting at 19, even though the market's only moving around at an annualized rate of 10. And that gives us a volatility risk premium, the difference between those two indices of 8.5. So option dealers are still demanding a premium to underwrite volatility here. We still could get that rug pull of a day, big red candle of a day, which would no doubt induce a lot of selling. Could be self-reinforcing. As everyone sees the election coming, everyone knows October seasonality is weak. We're already a little stretched, up 23% year to date. But the fact is we do have bullish seasonality and we're making our way through the back half of this month. So I wouldn't be surprised if we get that 2, maybe 3% down day, prove the option dealers right. However, I'd expect a quick buy the dip, because just looking at the way this market's been trading, barely be able to string together more than a couple of bearish breadth days. When every sector finishes lower, we're just constantly seeing those rotations. Like we did again today. Here's the one-day performance of the 11 S&P sectors. Energy performing the best, down the bottom, utilities and tech. And there's a look at the 1 month performance. See a bit of a clear rotation into growth. Down the bottom, REITs, staples and health, down over the last month. Up the top, industrials and financials, both up over 5%. That's the market pricing in that the economy is okay and it could keep expanding. And it's almost like the S&P 500 has a shot at hitting 6,000 before the election on the 5th of November. However, there's got to be some volatility beforehand or right afterwards, right? But just looking at that price action going into it, like I said, in what's supposed to be the seasonally most weak month of the year, especially coming into it hot, up over 20%, and an election year, looking back in history, most of the time October would finish lower. However, money doesn't lie. That's why we've got to listen to what it's saying, what it's telling us. If this is what the market's holding up in the most seasonally weak period of the year, what's it going to be like in the most bullish period? And after it can breathe a sign of relief once the election has passed. Typically volatility dies down after that, which I wouldn't be surprised if we got a massive VIX crush going into Christmas. Who knows, even taking us down to 12, 11, 10 that we quite often see once the storms settle. But politics aside, fact is, the market appears to be pricing in that this guy's going to win. Seen that with bank stocks, industrials, ETFs dedicated to American manufacturing, his own stock, along with crypto as well. Ever since his odds have been rising of winning, so is Bitcoin. And once again, we've got another billionaire hedge fund manager. This time, Dan Loeb said he sees green if the country votes red, and that he's positioning his $11 billion portfolio to profit from that scenario. He said, "We believe the proposed America First policies tariffs will increase domestic manufacturing, infrastructure spending, and the prices of certain materials and commodities. We also believe that a reduction in regulation, generally and especially in the activist antitrust stance of the prior administration, will unleash productivity and a wave of corporate activity." And it's true, that's the price action I'm seeing across the market as well. Dedicated ETFs, like the American Shoring one, once again breaking out to a brand new all-time high again today. Just like Bitcoin is moving up as well. And so as we all know, markets are forward pricing mechanism where they're mostly right most of the time. And how we get those big moves, if there's a difference between the expected outcome and what actually happened. So if we didn't see a red win, it's going to be a massive and sharp repricing in the markets. And so it's no surprise option dealers have to account for that possibility, even though that's getting lower and lower. We may not get the winner on the night either. After looking at what happened last time, anything could happen. But just looking at the latest odds, quite a stark difference now, 60-40. And US industrial stocks been on an absolute tear right along with those odds. But either way, even if we do get a red victory, could be a sell the news event and we get that pullback because the trade's just becoming too obvious now. Also likely holding up markets, retail sales coming in better than expected, rising 0.4% month over month, along with initial unemployment claims coming in lower than expected, 241,000 versus the estimate 260. Apparently all those hurricanes aren't having an effect on the jobs market just yet. We'll see what the October jobs report is that we get just before the election. So according to reports, Americans are still shopping, still out there with cash to burn as we head into the busiest retail period of the year, the 6 weeks leading up to Christmas, with Adobe saying holiday online shopping is set to surge. They think US online sales for the holiday season, November 1 through end of year, could grow 8.4% to a record $240 billion from a year ago. Last year, online shopping grew at an annual pace of 4.9%. So that's a pretty big number, 8.4%, if that's what comes in. And the good news is, in addition to the loan payment growth starting to come back, especially in loans versus credit cards, we've also got the percentage of banks tightening their loans to small firms, here in the red line, dropping sharply as well. That means credit's becoming more loose, more available, and the banks are more willing to lend to small and large customers. Unlike going into the global financial crisis, they were tightening and very quickly, just after they did after COVID. So that's another good sign for the economy for the here and now. And even though we got industrial production coming in a little lower than expected, Goldman Sachs has still got Q3 GDP tracking at an annualized rate of 3.1%. That's really healthy growth for a mature economy like the United States. And the way the stock market's trading, it's like it expects GDP to go up to 4% next year. And even the Atlanta Fed themselves posted today on X, they've now got GDP growth in Q3 tracking at an annualized rate of 3.4%, with their estimates trending higher over the last couple of months as well. And I'd say that's likely why treasury yields got a bit of a bump up today, especially in the long end. Appears the bond market maybe changing its tune, going from looking like it was convinced that a recession was coming, screaming at the Fed to cut rates, which they did, then ever since they cut, pretty much just bounced right up. Now got the 10-year hovering near multi-month highs, around 410. If this keeps making its way to 450, that's the bond market saying the US economy is A-okay. Just like high yield bonds have pretty much been telling us that all year, along with high yield credit spreads now down multi-decade lows. Investors not demanding much of a premium to lend to more risky companies, and that explains the rise in the US dollar the last couple of weeks as well. But what's really been holding the US dollar up the last few years, even though debt's blowing out, even though there's been a huge amount of new currency creation, is just the US economy has been holding up better than the rest of other developed Western economy. And with that, US bond yield keeping a pretty good differential between that and the rest of the global aggregate bond yield out there. However, if that gap were to narrow, global economic growth can come up along with yields. And if the US economy ever took a dip along with its yields, that could really cause an uncoiling in the US dollar, as there's plenty of other fundamentals for it to come down as well. But as long as US bond yields remain materially higher than the rest of the world, Europe, Japan, then the US dollar is likely to hold up somewhat, although I still think there's plenty of overhead pressure on it. And we may have just got the famous magazine cover indicator today as well from The Economist, with a headline, "The Envy of the World, America's Economy," a special report with some US dollars depicted around the starship lifting off and shooting towards the moon. Hopefully that's not a bad omen for the US economy to come. But no matter who gets in the White House, they're going to have a tough time dealing with all this debt. That's why the long-term threat remains to the US dollar, no matter who's in charge of it. Hopefully it's not past the point of no return. However, they're certainly doing their best to test that. Just hearing reports today, the US debt is up almost $500 billion in just the last 3 weeks. Look at this chart, it's incredible. Officials doing everything they can, throwing the kitchen sink at the markets to keep them goosed up on a sugar high for the here and now. What happens next year? It's just crazy to watch this. I started this channel early last year. I remember talking about US national debt, 32 trillion. Here we are, approaching 36 trillion, just simply out of control. But like I said, we've got the rest of the world in a global easing cycle now. European Central Bank just lowered its interest rates for the second straight meeting, helping to keep that big yield differential between Euro bonds and US bonds. Its inflation's coming down. ECB President Christine Lagarde is still pointing the risks to the downside with the economy instead of the upside of inflation, and they do have much lower growth than the States as well. And it's kind of interesting because I'm sure some of you guys remember a few weeks back, for a while there, and there's data to back this up, a lot of mainstream financial media just not reporting on gold, the US dollar. But does anybody else feel a bit of a change over the last couple of weeks, especially this last week, of who the media is seeming to support and talk about a little bit? Seems like some people are questioning their pre-held beliefs. But anyway, we're getting some articles showing up, like this one today. Gold may not reach a price ceiling anytime soon, saying foreign demand remains strong, and we are likely to hear more from the BRICS bloc regarding their de-dollarization plan. Western investors have been slow to embrace gold, and if that changes, it could turbocharge gold higher. The uptrend for gold looks strong, and I believe we could rally into year end. And we also got this article today. Gold is the last safe haven as treasuries face risks from soaring US debt. Bank of America. Seems like some of the system is starting to turn on itself, as I think we're just getting to levels that are just undeniable. No matter how much hate there is for a certain leader, I think some are starting to question America's finances and how we've gotten to this spot. B of A said traders and central banks should increase exposure to gold. They say treasuries face risks as US debt levels soar. They see gold hitting $3,000 an ounce by the end of next year. So that's a pretty conservative price target, only 11% higher. And this is on the back of the world's largest asset manager, BlackRock, also coming out lately and promoting Bitcoin with a similar tune, warning of the risks to the US dollar, the treasuries, government spending. It's kind of interesting to see a lot of the system try and separate itself, potentially hedge itself from the masters up top. So like I said, it seems like gold doesn't even care. The US dollar's been bumping up. Yields have been bumping up. It's just marching to its own tune higher. With silver also consolidating below yearly highs. So this is likely to break out again soon as well. We've got a lot of bullish seasonality coming in over the next couple of months. And Bitcoin as well, very likely to take a shot at all-time highs, above 74,000 in the coming weeks, in my opinion. Also got oil holding its ground today after US supplies show a surprise weekly decline, although they bump around a lot week to week. A lot of volatility in crude oil, up and down. Plenty of things to keep it bid, plenty of things to keep it offered. I think the big swing factor is where the Chinese put a bottom in their de-accelerating growth and market, because we know for sure the Middle East tensions are not going away anytime soon. Israel just took out the leader of Hamas as they once again picked them all off one by one. Still waiting for their large-scale response in Iran. Appears to be watered down from what we were initially hearing and probably what they initially wanted to do. But either way, crude is still bumping around, and I'll be looking for this big accumulation candle to get defended. It did spike down there, $67 a barrel. And just moving on to a reoccurring theme here at Click Capital, one of the most exciting sectors that I'm bullish on, nuclear uranium. Hearing more and more good news. Appears the world's coming back to it, and quicker than I thought, especially with mega cap tech. Just heard the European Union back in nuclear power ahead of their COP29 summit. European Union ministers agreed to support nuclear energy as part of the fight against climate change ahead of their summit next month, in a market shift on a power source that has long divided the bloc. So it appears Europe is changing its mind about nuclear after turning its back on it like much of the world did since 2011, Japanese nuclear disaster. We're also hearing from other developing economies like Turkey drafting a law to facilitate building small modular reactors, as they too are looking to embrace nuclear power as part of their renewable energy push. Even Japan themselves are coming back, allowing the country's oldest operating reactor to keep operating beyond 50 years that it was initially scheduled to be shut down. They too are coming back to it. And so it is staging a comeback around the world. As looking back, as a share of the world's electricity generation, it was 18% in the mid-90s, 9% today. And I wouldn't be surprised if come 2040, we actually double the previous record of 18%, 36, maybe, who knows, 40, even 50%. I think we're only scratching the surface of what's possible with nuclear energy. Has zero emissions, use up hardly any land, has minimal waste. And just as promised earlier in this video, I'll share with you one stock I'm looking to invest in next in the nuclear sector. So first, let me just explain a little bit about the technology behind this stock. So they're into making their own custom, unique, small modular reactors. And this could potentially be a big part of the future going forward for nuclear compared to the traditional large conventional reactors. And so the company I'm talking about is NuScale. And just as a quick reminder, this stock and all content in my videos is not financial advice. I'm just sharing with you my opinion and thoughts. Please always do your own research. However, why I'm excited about this stock is they could be a global leader in small modular reactors. In fact, their stock ticker code is that, SMR. And what's interesting about them is their Voyager plants can generate up to 924 megawatts of electricity. And so just to put that into context, 924 megawatts is enough to power about 750,000 average US homes for a year, just to show you how powerful and efficient they are. Some of the other benefits of small modular reactors is, again, they're zero carbon. They can provide baseload power that's a consistent energy output that complements other renewable energy sources like solar and wind, which is not always on tap available and is hard to store. They're really scalable. You could think of SMRs kind of like Lego blocks. They're built in the factory, then shipped to the site. They can be added from, customized easily, installed in remote locations, done really quickly, really customized for the customer. And just nuclear in general is a much more reliable, consistent energy source, and that reduces our dependence on fossil fuels, which brings with it a lot of geopolitical risks and tensions. And so they have multiple uses. And so to be honest, I'm kind of kicking myself that I don't already have a position in NuScale, as I've been a nuclear uranium bull for about 3 years now. I do remember looking at it earlier this year, but then thinking it was too expensive because it is burning through cash. I thought I would get another chance. However, like I said, this uranium nuclear bull is just picking up steam faster than what I thought, especially now with mega cap tech coming into it. It's getting more attention, and with that, more money, more investors coming into it. So I don't have a position in it now, but I'm planning to initiate a position once we come back to the 50-day VWAP, although I wouldn't be surprised if it keeps running. But just keep in mind, this is still very speculative, high volatile stock. Already has a market cap $4.5 billion, even though its trailing 12-month revenue was only $22 million. Just a stark reminder, the markets are forward-looking. So this stock's likely to have huge volatility, and I normally don't chase hot prices in the short term. I normally wait for a pullback or a dip. However, if they can pull this off, especially if they partner with some of the biggest companies out there, who knows? This could be a $100 billion stock within 10 years. Because if they lead on small modular reactors and the world's really turning back to nuclear, well, they kind of just have unlimited upside in my opinion, although it's not going to be a walk in the park. This is likely going to continue to have huge dips and correction. Just back in July, it fell 60% over 2 months. And that just looks like a little bit of a pullback on the chart here. So when I do initiate a position, it will be small. And like I said, this is kind of a long-term hold. But just looking across the sector, the main ETF URA traded up again today, and the wheels look to be in motion here. So if you want to stay up to date on this secular trend and other exciting secular trends around the world and all the amazing opportunities, then make sure you subscribe to this channel and click on that notification bell so you get a push notification every time a video is published. And instead of your head being filled with fear, like most other content creators, I'll keep letting you guys know about all the amazing opportunities out there and how this world is moving forward. Just moving over to the economic calendar. Eurozone inflation coming in better than expected. Global inflation still coming down. There's the interest rate, now at 3.4. Jobless claims coming in better than expected, along with retail sales, especially excluding autos. That was a pretty good beat month over month. Year over year, 1.7. Oil stocks coming in lower than expected. Later on in today's Asian session, we get GDP growth and retail sales from China, retail sales from United Kingdom tomorrow, and a bit of housing data from the States to finish the week out. And after that bump up in retail sales today, Fed Fund futures pulled back their pricing for a 25 basis point cut, and how markets change, starting to give a little bit of odds that the Fed may stay on hold just after trimming 50 basis points. Wouldn't they have an egg on their face if they did that? I think they might have to follow through with a continuation bet to back up their move, which again is another reason for stocks to keep trading on firm footing. And just going back to Netflix after hours as I speak, still up 4.8%, appears to be holding on to these gains, likely to gap up tomorrow, and we may see the Nasdaq Qs push up to weekly highs as well, along with Nvidia, still firming a little bit after hours as I speak. That may take a shot at closing above 140 for the first time tomorrow as well. But there it is, guys. Market continuing to grind. Haven't had a 2% down day for a while now, but like I said, option dealers are pricing in that possibility, but so far October seasonality is just not playing out this month. Thanks very much for sticking with Click Capital, and I look forward to breaking it all down again for you this time tomorrow. Cheers.